Hi, Anthony and Tara. Thank you for meeting with me. Today we'll be going through the Animal Care Center evaluation, business evaluation. Anthony, we're gonna go through some taxable gift. Also, I know you've been trying to transfer ownership to of the Animal Care Center to your employees, especially Eric. And then we'll be going through Edmund Benson, your nephew, and some education funding for Danielle. Okay, your animal care center will be evaluated using capital earnings evaluation. To do so, we need the net income of the last year, which we found out is $440,000, and the discount rate is 21%, which is 3% above the aggressive stock expected return. To calculate the value, we will do net income divided by the discount rate, which brings a value of $2,095,238. Now, Anthony, I also know you want to gift $1,193,600 of the limited partnership to Tara Nicole Ray and Danielle Payton. They will be each receiving 9% of the gift for a total for a total of 45%. Calculating that on the fair market value of the gift, it brings a total of $107,424. Moreover, there's gonna be a minority discount rate, which will lower the taxable gift again, the amount they're gonna receive. Sorry, and the amount they're gonna each receive is $79,573.33. However, there's a tax exclusion of 15,000, which lowers again the taxable gift for you of to $64,573.33. Now, only for Tara, which is your wife, there's a marital exclusion that brings the total taxable gift to zero. All the children will be the amount taxable is $64,573.33. Now, Eric, you've been talking to me about selling the business to your employees, especially Eric, which, if I remember right, is a vet. Is one of the two vets at your business, and is also related to you. In my opinion, the best way would be through self-canceling installment note, which you also call skin, which is a promissory note that is canceled upon the death of the seller, which will be you, Anthony. It mirrors an installment sale, and however, there has to be charged an interest or a premium as is required by law. The self-canceling feature is basically just in the case Anthony dies during the term of the note while the payment is still going. Eric then is relieved by any future payment obligations, and he will receive the entire asset free of any transfer taxes. So it's just a way to help your loved one, your care ones, like such as Eric. Now let's create a little bit scenario here. What if you sell the animal care center for the present value that we valued it for? So $2,095,238. Now the payment will be done in 10 years at an interest rate of 6.5%, and the payment will be $292,000. Now there has to be charged on interest or a premium, however you want to call it, because if you don't do that, if you don't do so, Anthony, you'll be subject to gift tax because throughout the time that there will be the difference from the value of the business at the end, but compared to the one you sell, create a difference that will be create a gift situation. Now, Edmund Benson, Anthony, is your nephew, which is disabled and receive government assistance. I know that one of your financial goals is to take care of him, help him with his life, with his financial situation. In my opinion, a possible solution is a supplemental need trust. It is a trust that allows a physical, mentally disabled, or chronically ill person to receive income without reducing their eligibility for the public assistance disability benefits. So Edmund, will not lose any benefit, any government assistance. However, these are irrevocable trusts, so Edmund may not request contribution or exert ownership. The assets in the trust will only provide a supplementary help. They're not to be used to live out of it. His main source of income and uh, support is the government assistance. And then Anthony, you'll be able to help him through this trust. Lastly, let's talk about education funding for Danielle. Danielle is your youngest daughter, and you guys want to send her to college, obviously, as you should. So there are three options. A Section 2503B, which is also called Qualifying Minor Trust, is an irrevocable trust which requires distribution of income on an annual basis. All or part of the gift gifted to the trust can qualify for gift tax annual exclusion. Moreover, there's a Section 2503C, which is a little bit different from the 2503B, because the trust is distributed to the minor once he qualifies at age of 21. The trust will be distributed to the minor even though she is not worth it. And however, the gifts are still considered present. The gifts are considered present interest gifts, and they will qualify for annual exclusion. Lastly, the option I prefer and I suggest is a 529 plan. It's a tax advantage account that can be used to cover educational expenses from kindergarten through graduate school. The growth is tax free, which is a great advantage. However, it has got some advantages like disadvantages, like there are no federal tax deductions. I know some states does, but most of them do not. And also, it limits the use for this saving account for just educational purposes, which is what we want. So that's my opinion why is good. And however, if you want to use the money in this account for something else that's not educational, there will be a 10% penalty. Well, this is all for today. I really appreciate your time. Thank you again for meeting with me. I'm looking forward to meet you guys again and moving forward into this in this process and provide you the best solution as possible. Hope you guys um, are gonna find this helpful. And please let me know if you need any question. If you have any questions.